Joining me here are a number of wonderful guests. First of all, we have Shep Hill. Shep is the president of Boeing International, not a new arrival on the global scene. So we're delighted that you're here to share with us. We have Gary Garibrandt, and Gary is the founder of Equity International and co-owner, and Equity International does extensive real estate development projects across the world with a number of those companies which are listed in local exchanges. We also have Scott Malpass, to whom I'm extremely grateful to be here because he runs the Notre Dame Endowment, and he's legendary. In terms of the returns that he has generated with us, he has featured oftentimes in the top 15 sort of magic and rainmakers. So we're delighted, and in our portfolio, we're also grateful to the investments in emerging markets. So how about we start with you, Scott, and we're going to have each panelist speak for about 5-7 minutes.
Okay, thank you, Carolyn, and good morning, everyone. I'm not sure I can do this in 5 minutes, but I'm going to try. I can't even introduce myself in 5 minutes, but let me start with a story because I am very bullish on emerging markets, and Notre Dame has a long history of investing internationally and in the emerging markets. But 6 months after Tiananmen Square in 1989, I visited China for the first time. And I had been in Hong Kong when I worked at the Irving Trust Company in New York City. Some of you are old enough to remember the old Irving Trust, which was bought by the Bank of New York in a hostile takeover in 1990. And a couple of the vice presidents asked me to go with them on a business trip to Tokyo and Hong Kong. And I just observed in Hong Kong, I had never been in a Chinese country. I observed an energy and a work ethic and a sort of an interest in getting ahead that reminded me of how I would imagine the U.S. might have been, in the early days. And it really piqued a real intellectual curiosity in me about spending more time there. So this was 6 months after Tiananmen Square. In Beijing, there were no cars. Everybody had the old Mao suits. It looked like a very depressed, culture in terms of just beaten down and 6 months after a terrible event in their country. But yet there was still an underlying sense of the future. And I went every year since then, and sometimes multiple times. But we didn't invest in anything in China until earlier in the last decade because it wasn't ready. The aggregate IRR of private equity funds in China had been negative, even through the 90s. But that really started a real interest in the emerging markets. Notre Dame has a multi-asset strategy with its endowment. We invest across all major asset classes. Today, international investments are almost 40% of our pool. Almost half of those are in the emerging markets, with a pretty heavy concentration in Asia today. I expect that'll increase over time. We went from doing, we started international. I guess the first international investment was in the early 80s, so we were kind of a pioneer even just investing overseas. Even before I arrived at Notre Dame, we had 10% of the fund in international. We continued to increase that. We started doing emerging markets on the public side in the early 90s. And of course, the first 10 years of that were not very attractive. You had several major crises during that period, and I know our board was starting to look at me funny at meetings, and why are we doing this? Because we hadn't made any money and we're taking a lot of risk. But I remember speaking in Mexico right after the peso devaluation, and we had just crossed $1 billion in our endowment pool in 1995. And somebody asked me from the audience, how many pesos equals $1 billion? And I couldn't calculate in my head, so I said, it's all of them. But the intellectual interest in emerging markets has just evolved and deepened over the years. We started with hiring sort of global emerging markets managers, and that was fine, but that was more of a beta play on the market. Now we don't do that at all. We have country specialists in all the major markets. We have some regional specialists, particularly in Africa and North Africa and the Middle East and in Asia. But generally, we prefer smaller country specialists who are really buying domestic companies, small and mid-cap companies in those markets that are really playing into the central theme of growth in these countries, in the consumer markets. The thesis for us is very simple, and Maynard talked about it at length, and most market strategists talk about it. We feel that certainly there's going to be higher growth in these markets, probably averaging 5 to 6% globally, higher in some areas and maybe a little lower in others. Rising exchange rates, the increasing share of world GDP growth, accelerating economic liberalization, strong demographics, which it's hard to underestimate, hard to overestimate how important that is going forward. And, the fact that these are complex markets actually works well for us. We have the endowments and investors that have a full staff who spend time in these areas. The complexity, we like that in terms of having to find the right partners, really understand the market structures, really understand government policy and reforms, and really thinking about the 10-year horizon and longer. So in many ways, it's an ideal asset class for an endowment investor that has a long-term horizon. Let me just wrap up with a couple of other just quick comments. We're currently in the middle of doing a very extensive special emerging markets project. The foundation, the BRICS, is very well established. And actually, when Goldman first coined that term in 2001, and the projections they had, they way underestimated what was going to happen the next 10 years. The BRICS have far exceeded even their very robust projections. And of course, now they have this next 11 they've identified that includes, Korea and Turkey and Vietnam and the Philippines, Bangladesh, et cetera. And, individually they may never rise to the level of a BRIC country, but collectively they could be as big as the G7 in the not too distant future. So there's the next wave of interesting places is very attractive. And we really wanted to develop a long-term roadmap that would be very dynamic. We'd look at it every year. Where should we be invested in the next array of countries? How much should we put in? What asset classes? Is it real estate? Is it private equity? Is it public equities? Are there credit markets? And the markets are very different. I think about India, where the discount between public and private isn't really that big, but it's huge in China and in other Asian countries. So thinking about the asset classes and what's most attractive and where would we have an edge in developing those relationships is something this project is designed to lay out. We've identified 12 major categories we're going to explore. And we don't have time to go through all those today, but it would be the obvious things that you would think about, sort of the structure of the markets, liquidity, market cap, other credit markets, government policies, fiscal conditions, political stability, cultural issues, which I think, and I know Gary will absolutely agree, is one of the major areas a lot of investors really overlook in terms of thinking about the long-term potential and success. I just got back from 3 weeks in Southeast Asia, for example, and it's easy to lump a lot of these countries together, but in trying to think about, who's going to do better, Vietnam or Indonesia or Thailand, and you start to think about some of the cultural differences, and the way I would separate it a little bit, and Carolyn can correct me if I'm wrong, but I kind of think of the sort of the Sino-Confucian countries, even starting with Japan, China, Korea, Vietnam, certainly Singapore, Hong Kong, Taiwan. These are people that want to achieve. They work hard and they feel there's something out there and they really want to achieve. So that group I would continue to be stronger on in general, some of them stronger than others. I mean, we've talked about Japan, some of the problems there, but they've had obviously incredible economic growth over the last 40 years. Then the next group might be some of the more terrestrial Southeast Asian countries like Burma, Thailand. The Thai are South Chinese, so they have some of that in their culture. Maybe Cambodia. And then the next group, maybe I'm not as strong on, might be sort of the Malaysian, Polynesian, more island cultures, which would be Indonesia, Malaysia. And I know there's a lot of differences of opinion on Indonesia because it's so big and has the biggest population base. But there's an argument that culturally that may not do as well as, say, Vietnam, which has some real political issues. So there's a lot to think about. It's very complex. And those are the kinds of things we're spending a lot of time on. In terms of the positives from this trip, obviously, they're talking about regional exchanges, the demographics we talked about, increasing tax incentives, a lot of things to be positive about, and there are negatives. Quality of management isn't as good in a lot of these companies. Inflation is a real concern. And actually, there's a camp of people out there that think the inflation rate in China is actually much higher than the stated 5%. Actually, could be more like 15 to 20%. And if that isn't controlled, that'll be a real problem for Asia. And so that could be a wild card that isn't fully understood yet by investors. And so we're trying to think more about how that could play out. You know, the size of the informal economy, which is a term I heard many years ago, which I find very interesting in some of these places, is 50-60% in Southeast Asia. And so that has to change over time. So there are a lot of reasons to be concerned as well. But overall, you know, for an endowment investor thinking long term, I would expect at some point that our emerging market strategy, assuming we find the right partners, the right kind of people to work with, could approach 25 or maybe even 30% over the next 10 years. And be happy to answer questions when we get to that point. Thank you.
Thank you. Gary, could you take that mic?
Scott earlier expressed some concern about following me in the introduction, and he so elegantly turned the table. We're privileged to have Scott as a partner, and delighted with our business, which from the inception has been focused on the emerging markets. We were inspired by the fall of the wall in 1990. Sam Zell and I started traveling in the mid-1990s, spending considerable time in Eastern Europe and Russia, Central Europe, Central Asia, and through Asia, and after traveling the world, discovered that Mexico offered the greatest opportunities. At one point, we were the most active international investor in Mexico. We had 5 portfolio companies. We rang the opening bell at the New York Stock Exchange with one of them, Homex, which became the largest home builder and leader in the affordable entry-level segment. We learned a lot about partnering. We're among the 2 or 3% where joint ventures have worked. We only invest through partners. We wouldn't do this without partners. Our focus has been exclusively on the emerging markets. We're a builder of companies. We're not a property or real estate project investor. We've built over 20 companies in the emerging markets. We've rung the opening bell 3 times on the New York Stock Exchange with our portfolio companies. We're now organizing our Fund 5. I think regulations will allow me to say that. Our returns have been terrific, which is why we're organizing Fund 5. And we're now dominant in Brazil. Like Scott, we think of the world as core and emerging or frontier. For us, core is Brazil, Colombia, Turkey, China, and we've got businesses in most of those countries. We're dominant in Brazil, as I said, with 6 portfolio companies, and for us, frontier is Indonesia and Vietnam. Parts of the Middle East, we have a business in Egypt, and we just did a round-the-world trip and visited many of those places last week. We are very excited about the emerging markets going forward because we see growth of the middle class. We see aspiration. We see youth. We're very focused on scalability. We're not interested in small countries or small regions, which is why I referenced the countries I did. We're also very focused on sustainable demand, fundamental demand, not engineered demand, like what was the case in Europe, throughout Western Europe and the United States, which the demand was entirely engineered by finance. We are active in markets where the demand is fundamental, and most people are uncomfortable borrowing money, too much money, I'd liken it to the United States in the 1950s, where people are getting their first job, their first house, and it's a very exciting time. So as a result, most of our businesses radiate from the growth of that middle class: home building, specialty finance, retail property, warehouse distribution, logistics, etc.
Thank you. Chef?
Great. Thank you, Carolyn. Great to be here. At the panelists, look forward to questions. I won't take as long to go through my points because I think the best engagement on a panel is the questions that you have so we can focus on what you're most interested in. Boeing obviously has been a global company for a long time, and I use the term global very broadly. It doesn't mean that we've manufactured like Procter & Gamble or Coca-Cola, but we've operated globally for a long time, had customers around the world. But if you look over the last 10 years, really, it's just amazing the acceleration of growth around the emerging markets. And quite frankly, the change that is affecting our business, our country, and Boeing in particular. 2020, you look at it, 1/3 of the global purchasing power will come from emerging markets. By 2020, 50% of the incremental GDP growth in the world will come from emerging markets. Some people argue, Goldman Sachs, for instance, that almost 2/3 of the incremental growth since the financial crisis, quite frankly, and going forward for the next 10 years will be from emerging markets. To talk about the demographics, which are shifting, 1.3 billion people in the next 10 years will move to the middle class. In China, over the last 10 years, 400 million people have moved into the middle class. In some instances, from subsistence level into the middle class. So just an immense movement, demographic implications and business implications. If you translate that type of wealth movement, if you translate that type of demographic change, for instance, to our Boeing commercial aircraft unit, next 20 years we anticipate just in Latin America, China, and India, 7,600 new planes, incremental new planes for airlines, about $820 billion worth of growth. If you just separate it and cut it a different way and look at Asia, over the next 20 years, 9,000 aircraft we expect to be purchased. 40% of those will come from China. So the idea that it's a multipolar world is not a forecast, it's a reality. You just have to look around what's happening in the Middle East right now. You have to look at what's happening in Asia. The other part of what we're seeing is don't ever confuse the unlikely or the unexpected with the unlikely, I should say. The unexpected with the unlikely. It happens if you look back a month ago in terms of where the CIA was looking, where the U.S. government was looking, where Boeing was looking, quite frankly, in terms of issues. It was China, it was Asia, it was India. And all of a sudden, we have a world situation in the Middle East that's impacting oil, that's impacting markets. So it is a global economy. We've always known that. And I know everybody cuts the statistics in different ways, but as you travel around the world, you really get a great sense of that. I just came back with our chief technology officer from Israel and Turkey to kind of get a feel for the region without being in the region. How do you get a sense for what's going on without getting evacuated? And it was just fascinating in terms of, obviously, Israel is distinct in terms of what they feel, and I won't violate a confidence there other than to say, a siege mentality, but Turkey, which kind of carries over the border between the Middle East, between Europe, just a fascinating view of how they think the world. Do they fear what's happening in the Middle East? They don't fear what's happening in the Middle East. They think it'll come out in the right way and it'll create more opportunities going forward. Little segue then to what does it mean for Boeing? And as the president of Boeing International, we've been successful for 95 years in Boeing. We're in our 95th year. Obviously, we have a vision to get to 2016 to be 100 years old. Most difficult thing in light of the pace of change is how do you tell a company that's been successful for 95 years that you have to change significantly? And it really comes down to a couple of things that I'm known for within the company. I got friends and I got foes as a result of that, which is, our perspective. We have to completely change our perspective. We tend to be insular. If you're in Seattle, you build planes, you send planes away. If you're in St. Louis in our defense business, you kind of hunker down there and think the world will come to you. Well, the world's not coming to us anymore. So your perspective has to be vastly more outside-in oriented. Along those lines, expectations. We have to understand the expectations and aspirations of all the countries in which we operate. You're never going to fly in and fly out of a country after making a sale. Just not going to work. what are their expectations and how do you align our business strategy with the aspirations of a country such that they can dovetail and they can be synergistic going forward. Assumptions, as this past 2 weeks has indicated, question all your assumptions. You know, down deep inside, if you cut off a Boeing engineer's head, you find out that they don't feel they're arrogant, they just feel they're right all the time. And that's not to say I'm watching some of my engineering colleagues over here. They have been right for a long time, but the fact of the matter is we have to question every assumption. And the biggest assumption we have to question is that we are exceptional, that we do things other people can't do. You want some of that bravado in there, but if you look at China, if you look at India, if you look at the Middle East, they are all hungry to do the same things that we do. They're going to demand that we cooperate and collaborate with them to do them. And they want their stake of their young people to rise just as we have seen our young people rise and have opportunities going forward. So it really is a brave new world out there. The pace of change is accelerating. The competition will accelerate. And I think from a company perspective, your ability to adapt, to understand that change, immediate change, unpredictable change, is what is predictable for the next 10 and 20 years. Something new is going to come up all the time and challenge your business plan and challenge your culture. So look forward to your questions.
Thank you very much, Shep. We collected a few questions, so I would like to start with Ninad and to answer a couple of the questions that came from the floor, and then we'll open it up.
Thank you, Carolyn. There are basically two questions here related to joint ventures and why they tend to fail in emerging markets, and basically usually three reasons. One is that companies go into financial clashes with a local partner, and usually the local partner doesn't have the funds to follow you in terms of growth and strategy, so there's always a financial issue. Then there are all sorts of managerial clashes which come out on a regular basis, and then cultural as well. And it's just to name a three. There are all kinds of other things that can go wrong as well. And I think companies are simply not managing them properly. And it's just too much of a nuisance, I think, for many firms, and it's rather go greenfield or acquire with the proper due diligence rather than go into JVs unless you have to. So those were one was about JV in India. Partner is an excellent person, but our business goals are not converging. So that's one of the questions here, and I think that's exactly what's happening in many other JVs that we have seen over the years. The other one was how do you manage insecurity and instability risks. I think I spoke about the staying power in the markets, especially when it comes to sales, and pulling out too early and prematurely is always, well, actually mostly it's a mistake, because markets, whatever they go through, usually they turn around and go back to relative normality. So maintaining the sales strategy always makes a lot of sense. But I think, as I said during my talk, anything that has to do with physical asset investments at a time of insecurity and instability, you would want to think twice at the moment putting another plant into Egypt or Tunisia. Just wait and see, but why not keep selling? And there was one more related to, I'm not sure I can read all of this, but leadership.
You can answer it in any way then.
Exactly, yeah. I'll just invent something. No, I think it's about leadership in emerging markets. I think, as I said, companies are moving away from having good managers run these operations, but really having great leaders on the ground increasingly. And just to echo what Scott said as well, instead of regional, you have to be country level, and you have to get great leaders on the ground in all of those places. And so disproportionate investment needs to be channeled into developing leadership skills at the top level, peak level, so that people can do all of those things that you mentioned as well, Shep, regarding how do you change the company internally, how do you move from insular culture to a different global perspective, and I think that should be part of any leadership program as well. I think it's absolutely correct. So these were the questions, but if you have any other question, please.
Floor is open to any of the panelists and to our speaker. I have to repeat the question for the taping. So Anne asked, what factors drive your success in joint ventures in these emerging markets?
Well, I'll start with recognition that in emerging markets, one is generally trading rule of law for growth. Okay? People don't like to say that, but that's what it is. One would hate to be pursuing judgment in any of the countries we've talked about. We wouldn't do it, in fact. So in a very practical sense, partnering is essential, and evaluating the quality of the partner. We're a private equity firm. We build businesses. We're building organizations. We spend extraordinary amount of time learning and evaluating. Our business has evolved such that we know what businesses we want to be in, who's playing in those businesses, and using our network, which is extraordinary, to evaluate these people. The senior team travels so much, and when we started the business, we were young, and some of the guys were bordering on handsome. Now we're old and broken down. I mean, it's a rough road, but and yet that's what's required to understand whether or not somebody's actually going to be really sharing the vision, aligned, and I would say committed to the highest corporate standards. We don't feel pressure to invest in places where we don't find world-class partners. And a lot of large companies, particularly public companies, echoing remarks earlier, they have pressure to be everywhere. And being smaller is a luxury because we don't need to be everywhere. So we've not made an investment in India, for example. Why? Because we haven't found the partner. Haven't made an investment in Russia either because we haven't found the right partner, at least for us.
She's a Russian expert, speaks fluent Russian, so
Yeah.
just want to...
You know what? I learned what that expression means, so I'm not gonna take you up on that.
I go, Peter.
The events of the last several weeks are a little startling, and North Africa and the Middle East, and it kind of looks like maybe sub-Saharan Africa and parts of even Latin America may change geopolitically. And I wonder how the panelists might respond to what impact this might have on emerging markets as well as on the global economy.
The question relates to the recent events in Africa and the instability and riots, and what is the footprint of that particular set of developments?
Peter, let me take a shot at that. I don't think we know yet what the complete answer to that is. On the one level, again, tangentially in the region, is this the fall of the Berlin Wall? Is this the rise of liberal democracy? Is a youth movement there that's going to make this a benign and democratic takeover? Or is it going to be, in the words of some people in Washington, hijacked by organizations that are more radical? If you look at Egypt, for instance, it benefits from ostensibly from a stable military transition, oversight of the military to transition, but just as in the United States, it's not always the best candidate that gets elected, it's the best organized candidate that gets elected, and you'd have to look at the Muslim Brotherhood there and in terms of a potential outcome. So to the point that was made earlier, you got to stay close. You can't abandon ship in terms of, I think you watch out for the safety of your people, but if you had partners there, if you have markets there, you got to try and stay the course and see what happens on the other end. But I'm not sure anybody quite knows how far this will go or what the ultimate consequence will be, or if it will be country by country in terms of what evolves versus just kind of a mass elimination of communism in Eastern Europe, as example. That would be my take.
I might just add, Peter, it is complicated, and the only thing I would add is that, there's been a rolling series of crises in the emerging markets for the last 20 years, and assuming this one doesn't lead to a total implosion, there'll be, from a global strategy standpoint, there'll be tremendous buying opportunities, both public and private. So we'll be monitoring that to see.
I think the short-term impact, by the way, from all of this is already you see a significant decline in sales of multinational companies in some of these markets. And the other point of impact in the short term, obviously, are very sizable increases in commodity prices, which are hurting everyone globally. So I think it's a real global impact from this. But at the same time, as I was saying during my speech, I think in most markets things will calm down. And in the end, it's actually, if you think about all of this, it's not surprising it's happening. It's surprising that didn't happen earlier, because huge amounts of population have been just ignored over many, many years. And the trickle-down effect was not there. Egypt was doing well for several years with a very good government. I met all of those guys many times during the years, and they were very pro-business, great government. And Egypt is not going to get that type of pro-business government again in the next few years. But they will get probably a government which will be more statist, like the one between 2000 and 2004, which has not really been great for business. So I think you will probably get some complicated coalitions in some of these places where the maybe pro-business agenda will not be as strong as it has been for, at least from a purely cynical multinational business perspective. It's a different story when it comes to people on the ground. But it's not so really surprising what's happening. And it's, in a way, it's good it's happening earlier rather than later. The later, if it were happening, then, of course, I think the anger and the hunger would be bigger. And I think more people would be going into certain, let's say, religiously driven parties rather than now. I think we're still at the stage where this can be managed with a clever mix of military playing the good guys, paying off the population with subsidies, increasing public sector wages and getting people off the streets, and then managing the transition through some kind of, let's say, semi-democratic elections of some kind.
If I could, the one, and those are, I think, very thoughtful, accurate comments. This is what happens when the dog catches the car, all right, and doesn't know what to do with it when it does it. And I think there is some aspect of this in terms of these revolutions. I would say, though, that the people in the regions of the Middle East, a lot of highly educated young people in all these countries, in Saudi Arabia, Egypt, have engineering degrees. So whatever comes out of this is not, in my view, going to be the Taliban, because there has to be some sustainable economic growth that satisfies some of the problems that face those countries. And in that regard, I hope it does in the end up being more business friendly. I think initial skepticism on anybody who is with the old regime can't be with the new regime, but at the end of the day, I do believe to sustain growth, which is what they need, that they will come up and see the rest of the world. Even China's doing that. China's the greatest example of state-planned capitalism in the world, because that's what the people need for them to maintain authority, quite frankly.
John?
This is actually a question for Shep. Synthesizing a couple of the points, Nana says, tell Wall Street to go to hell. And Boeing, your numbers, huge numbers. Those numbers are projected playing ground. In 1993, actually, we had the pleasure of listening to the senior economist from Motorola who said, hey, China, growing, 100 million to 300 million. They're going to buy phones, they're going to buy cars, they're going to buy gym shoes. We have a problem. Where do we put the waste? Where do we do this? And so we have to build a 20-year plan for the ancillary issues for our principal market. So looking at Boeing, you need airports, you need concrete, you need airspace. That is not a story that Wall Street cares about. So how do you actually tell Wall Street to go to hell without getting kicked out of and still actually handle that sustainability?
Bill, would you do me the favor of summarizing John's questions? Okay.
Do you need to repeat that for the camera?
This is tape back to students.
So leaving, are you allowed to say hell at Notre Dame? Okay. So the question, I think, was how do we, in a world to support the large numbers of aircraft that we have or we hope to sell, with all the infrastructure requirements that go along with that Wall Street may not value, how do we, in effect, blow off Wall Street in the process? Is that kind of it? Well, we don't. Investor relations in Boeing does that, all right? I think, two types of questions. One, I do think for American companies or multinationals, there is a growing sense that if you're going to be investing in the long run for emerging markets, we got to figure out how to translate that better to Wall Street in terms of a focus on quarterly earnings and how much capital investment and how you're building infrastructure around the world. So that's one issue. We have to, even as Goldman Sachs comes out with all these estimates, I don't think Wall Street fully understands globalization, fully understands the opportunities and the competitive peril that countries have unless they invest. But two, like China, they're going to build the airports, they're going to build the infrastructure, they're going to, interestingly enough, in terms of the estimates I gave you for our planes, they're going to manage at the government level how much their airlines grow, what planes they buy, and who buys those planes, how do they buy those planes, and how they allocate those planes. An interesting aspect of China, for instance, is it's both political and commercial. We used to own 70% of the market share. Now it's about 50-50 with Airbus. So they apply politics to the EU and the United States, as well as the value of our planes, for instance. But the question I thought you were going at is, we have to invest in China and partner in China for them to buy our planes. We have to transfer technology to them for them to buy our planes. And they have already announced that they will build and fly by 2016 a 737 class aircraft. So in the long run, we are collaborating with a competitor. That'll be a very forceful competitor. But all that comes into how we talk to Wall Street in a fashion that gets them off the quarterly earnings. And, the classic that you should all push back on Wall Street, if we come out and say it's going to be this EPS, $10, earnings per share, and they go, no, it should be 12. How did you come up with that? Okay, we know the company, and we say it's supposed to be 10, and then if you don't make 12, you get knocked down in the market. So I don't think I precisely answered your question, but it's an ongoing dialogue, and Boeing can't afford ever to tell Wall Street to go straight to hell. Yeah.
Questions on this side? Yeah?
I'd like to make a comment first that I thought your presentation on the mark, and I'd love to share it with so many people in my company. I wanted to say I told you so many times in your presentation, and so that gives me the opportunity to maybe challenge one point that you made. And that one is that you made the comment, don't just focus on the record. And I get that, but at the same time, with limited resources, it's very tempting because we have the philosophy that you have to win in China in order to really win in these emerging markets. So you kind of start to want to hone that in, focus there, and then what you do there, you want to make sure that wins elsewhere. But I can't resist the temptation to want to win in China first. And so I'd like to give you the first chance to respond to my thinking there, Nina. And maybe it differs than yours, maybe it does not. I'm not sure. And if anyone else wants to chew on that, feel free to respond.
Thanks for that question. It's a very thoughtful one, and many companies are struggling with this. And particularly, I would say, in the U.S., many companies are extremely obsessed with China, and they still, for some reason, hate Russia, for example, which, sometimes it's quite hard to understand. There are all kinds of perceptions out there, where every market has its own perceptions about certain areas of geography and so on. But I think focusing on BRIC, I think you have to be there, one way or the other. I think for the long term, there's no question about it. The other big question is then, if the resources are an issue, which for many companies they might be, especially medium-sized companies, how do you then go beyond the BRIC and establish operations in Eastern Europe, in the Middle East, and other parts of Latin America, and so on? What some of my clients have done, well, let's say medium-sized companies, let's say several billion in sales, and they want to be significantly bigger, is to go and set up regional offices that will look for business opportunities on the ground in Latin America, in the Middle East, in Central and Eastern Europe. So you appoint a regional head as a starting point, and it doesn't cost that much. You open a regional office, it will cost you whatever, $1 million a year or something like this. Go out there and in the initial stages do the things that you don't want to do over time, which is fly in, fly out. But in the initial stages, you have to do that as well. Sign up some distributors, show to the people, to you and the others in the organization, there is business in those places. and then suddenly start to gradually beef up that regional presence initially, and then select a few markets where you want to go into that one man and the dog office in Warsaw, one man and the dog in Istanbul, and one man and the dog in Santiago de Chile, etc., etc., and then from that you sort of try and expand. So it's not a huge outlay going in that direction, and it gives you an opportunity to look for new business out there. And as I said during my talk, then once you have those people, at least at the regional level, you realize, well, there is business here. And suddenly it pays off. The presence pays off in a year or two, or maybe even quicker in some places with a few contracts that you sign, and then it sort of becomes a self-financing venture. The other thing, of course, is look at the options to raise financing along those lines that I discussed. Raising some local financing in local corporate bonds, if you want to list on the ground in some of these places, in tiny emerging markets. That's another thing to look at as well. But maybe a comment also from Shep on this.
No, I think you did.
Yeah, I'm going to make a point. The BRICS are an obvious place to start because of the scale. There's just so much population. There's other considerations, partner quality, et cetera. We have 3 portfolio companies in China, and China we view as evolving in the sense that the first generation entrepreneurs are stubborn, are very chairman oriented, don't respect colleagues, don't prioritize organizations. Organization building. I made those remarks at Wharton recently, and a Chinese student raised her hand in the back and said, "Are you certain about all those things?" I go, "Yes, I'm certain about all those things." She goes, "Well, my father's one of them." So I would actually confirm your remarks. Now the next generation is really exciting in China. This is the Tiananmen Square protesting generation, because they are more worldly, not just because they speak English, but because they've traveled. Many of them went to school in other countries, and it's a very exciting environment. We believe for that reason.
Scott, just to come back to you and get a little bit more focused on MD, when you're looking at emerging markets and the amplitude of investments is a little bit more pronounced than investments here in the United States, how patient are you, number one, with investments in EMs, and what do you consider your long-term investment? You mentioned long-term a couple times, but I'm curious what that means for a 170-year-old.
Scott, repeat that question first.
The volatility of emerging markets and how we think about that versus U.S. investments, and then what do we think about long-term? What is long-term for us? It's a great question. And honestly, to invest in emerging markets, any investor, and particularly an institution, the governance board has to be fully in concert with the understanding of the risk and volatility. And I've been blessed with an outstanding and very knowledgeable investment committee with people who represent all the different asset classes and who have experience investing overseas. So, we factor in that volatility and how we put the whole mix together. We know that that's going to have a higher volatility than large cap U.S. stocks or other kinds of investments we do. So it's the whole mix of beta and the risk of the entire portfolio that we're measuring. The size of this ultimately will also have to be evaluated relative to those other investments and the risks of those other buckets, if you will. So it's a total portfolio approach. We can't just put as much as we want in emerging markets because it has higher growth rates. We do have a campus we're supporting. We spend 5% a year on scholarships, on faculty, on programs. So there is an underlying operating business, if you will. So it isn't just we'll do this for as long as we want and it doesn't matter the volatility. The volatility does matter. But long term for us, really, I do think in more like 7 to 10 to 12-year segments, and you have to buy into that, especially in the emerging markets. But we do a lot in private equity and venture capital and other areas that also have very long time horizons. Liquidity is also a factor in how we would size this and how much we would do in public versus private. Because, again, we're spending, so you have to, how much illiquidity we're willing to take on. Yeah, there's a maximum to that, right? Even though we may feel that it's going to have a higher return, but there is a maximum of illiquidity that we're willing to take on in our funds. So all of that together result in an allocation and help us develop our strategy there.
So all that together, does that indicate that you tend to be more patient with the EMs or less patient?
No, I think more patient. I think more patient overall, particularly in the private aspect, because we're actually doing more in private equity in China than public equity. We're doing more in public in India and so far in Brazil, but we're going to do more and more private in Brazil, both in private equity and real estate, and more private in Russia than public. So it does vary a lot by market. But we do put it all together. It's a total approach.
One of the things, Scott, you said earlier, and which was interesting, what you said, you were looking at buying some purely domestic companies, right, and you're doing so, and it's in your portfolio. And I think that's incredibly smart, because what I see from my multinational clients is they are now actively looking at buying them, all of those domestic players, to take them out of the market before they become too big and complicated as competition. So I think those returns will be phenomenal on some of those players.
We're seeing a lot of acquisitions in some of our underlying portfolio
Absolutely.
companies.
It's exactly the right thing to do. It's very smart.
In your presentation, you talked a lot about the post-crisis world, but one of the things a lot of people have talked about is global rebalancing of demand, and how that plays into how emerging markets grow. Their economies traditionally have been through a competitive currency, low manufacturing costs. How do you see that playing out now? Because that's clearly not, it's a zero-sum game, and China's fully integrated into the world economy. I heard Paul from the Mexican finance ministry. He said that 10 years ago, Chinese labor costs were a third of Mexico's, and today they're only like 12% less. Obviously, the transportation costs and other things, that differential is much, much lower. So what is your sense on how this might play out from a country perspective?
I think it's a great question, and it's one of the reasons why we ended up in this global crisis earlier, because the global economy was a little bit like a drunken man leaning on one side, just about to fall, with extreme consumption in some of the places like the U.S., and then huge savings and not much spending in some of the emerging Asian economies. And as you say, many of them were simply buying whatever treasury was, in those days, George W. Bush pushing out to the market. They wanted to keep their currencies cheap so they can export and have an export growth model. This is fine for a while at this stage of economic development, but as you know, most of the Asian markets have been doing this. They're running already sizable current account surpluses. And I think what we will see over the next few years is gradual rebalancing. I don't think we're going to see any sudden rebalancing of global economy. This is what's happening now with the developed world not growing well and emerging markets growing faster in the next few years. That will help by itself to some extent to rebalance a little bit. But I think the consensus view of the people who are looking at this as well, and I'm looking at this myself, I think this is a 10 to 15 year thing where there will be gradual rebalancing. I would be surprised if any of those Asian economies now suddenly decide they're going to let their currencies appreciate so much that they turn overnight to some domestic consumption-driven model. I think it will be gradual. Same in China. I don't think anybody is going to let the local currency appreciate more than 4 or 5% a year, and anything beyond that would be quite detrimental to the export-driven model over there. So it will be a gradual, I think, occurrence. I'm not sure if the other panelists are sharing that view, and I think everybody has a view on this as well.
I think in China, I would agree, although I think they're going to really accelerate trying to become a consumption model. I think the financial crisis showed that they had a vulnerability, and that being primarily based on export could impact their long-range plan, and as a result, I think they are looking at innovation. I think they are understanding they have to have a more consumer-based economy. I think they want to get away a little bit from the foreign currency reserves they have in the U.S. in terms of just the business case there. I mean, if you look at what's going to happen in inflation and the devaluation of the dollar. So I agree, but I think they might be more purposely moving to accelerate more than we might give them credit for. I mean, China's a fascinating country as it relates to them subsuming ideology to get the job done in some fashion. Even as they are now looking at inflation, I don't think they'll be able to limit it to 7%. But the fact that they're willing to say that they're willing to try and control it, that they're willing to try and avoid a real estate bubble, just shows that they're very thoughtful about being good capitalists.
I just want to add from a Chinese point of view, Chinese are seldom ideologues. They're very pragmatic. They're entrepreneurs.
Right.
They're into problem solving. Control is more important than ideology. So that's the point. I want to ask then, amidst all of this, clearly the U.S. unemployment is an issue. And one way we could possibly sort of handle this issue is that we become more export-driven, that we're competitive. But in light of emerging markets, they're not just going to be importing our goods. We're going to build up, as you say, sort of a lot of local and regional activities. How will the U.S. come out in the next 5 or 6 years as these markets not only expand their consumption ability, but they're also expanding their production capabilities?
A great question. I don't know I think it was CBS last night or the night before last had this issue about, I don't know if you all saw it, they went to a home, said, how much in this home do you think was made in America? And the family said, well, I think it was a fair amount. Well, they started turning over things. But the deal they had with this family is, well, why don't you go stay at a hotel and we'll take everything out of your house that's not made in America. And they went and they came back. There was nothing left in their house. The appliances, the bed, the coffee maker, everything was gone. And so it was a very useful illustration, I think, for the American public. And then they did some facts which said, if American public would just buy, I think it was 19 cents a day more worth of U.S. products, it would result in 200,000 American jobs. So, to your point, we have to be local. We have to help develop the skills and expertise. We have to, on the 787, almost 70% of that is made around the world. We need to balance that, but for us to remain competitive going forward, we have to also provide middle-class jobs. We have to do something that builds the skill base, the educational base in this country, or we will lose the ability to innovate. And the only way we stay ahead of China when they build a 737 class is qualitatively to be better through innovation. So I think we have to do both. And when I know everybody on this panel and all of you have traveled around the world, it's scary to see what we don't do well and what other people are doing, reading from our playbook, if you will, and doing it better. And we desperately, as a country, need to get back on track there.
It seems to me that, I'm thinking of the developed world now, the Germans have kind of made that transition a bit. They're exporting a lot more and doing very well through this crisis as a result of having suffered the harder time before and now having made that transition. So maybe there's something there for us to learn from.
And here's the irony, the most productive BMW plant in the world is in Charleston, South Carolina. They make X3s there. So they have found a way that, they can be local, the profits still come back. But that also proves to you that American workers, it's not being outclassed, it's just being what process do you bring, what focus do you bring.
Shep, I was just wondering, do you see any other competition beside Chinese that will cause headaches for you in the next decade? The Russians, whatever, Brazilians, whoever might be coming.
They're all coming. They're all coming for the same reason we're in it. Large markets, skills, good jobs that come from it. So we see China because they have a huge market themselves that they can sell into. They've made it a national priority. They have a lot of money and they have a skilled populace that could get into it. They launched humans into space in about half the time that we anticipated they would be able to do that. So game on there. The Brazilians are already doing that in terms of building very, very capable regional jets. You all fly on them everywhere. They're very good. And now they'll eke up into the 737 class. So that's a business strategy. Do you partner? Do you co-opt? How do you do something? Because they're coming. And the Russians certainly have the skills and the capability to do it. They don't quite have the domestic market to give them that impetus yet. But they'll be there as other people will be.
Peter?
Yeah, Andy Grove last summer had an op-ed in Bloomberg News where he talked about the decline of scalable manufacturing in the United States. and he pointed in large part to policy decisions. Rightly or wrongly, he made the argument that China was out manufacturing us, not in totality because of labor markets, but in part because of investment in scalable manufacturing and also in government policy decisions about scalable manufacturing. How can the U.S. address that?
All right, I'll take while we're all collecting our thoughts. I mean, you have to. We have a crisis in this country as it relates to that, whether it's tax, infrastructure, or education. There are a lot of jobs in this country right now that are available. We have, as you've all heard, we have a skill mismatch. So we need to get on the ball about the education system, K through 12, what we turn out of our great university system. We got to figure out what happens to these students. How are we able to take this mush that comes out of K through 12 and turn it into great people that come out of a great university system? Our infrastructure. Our corporate planes are down in Gary, Indiana. That's where we land. We come into Midway sometimes. I have to tell you, I drive through there, and this is no insult on Gary, Indiana, but you come back from Beijing, and you land in Gary, Indiana, and you kind of go, are we focused on the right thing here? So infrastructure is a key part of that. Tax structure that would enable investment here. All these other countries have figured out how to get foreign investment in their countries through thoughtful tax. And I'm not saying give multinationals a free ride, but make it easier for Intel, make it easier for Boeing to do that here than it is to doing it overseas. We're all among, having a conversation here. I'm not worried about American business. I'm not worried about the skills of people that come out once we get focused on it. I'm worried about our political system being able to keep pace with the pace of change that's happening around the world. We're spending a year discussing certain things while other people are doing them. We're debating whether you do infrastructure while China's doing it. Should we have high-speed rail in this country? And China's building countless miles, thousands of miles of high-speed rail. Why? Because they analyzed what happened after the Second World War in the United States. Infrastructure development, education enhancement, opportunity enhancement, and they're doing all that. And we're talking about it.
To follow on that point, building high-speed rail between Tampa and Orlando sort of captures the absurdity of what's being proposed in this country. We can't get back to business without solving for Medicare, Medicaid, tort reform, government workers unionizing, collective bargaining. What are they talking about? People in private sector have been suffering for 5-7 years while there's been this floating going on. The country can't afford what we were paying, what we were supporting over a 20 or 25-year period. And sophisticated people understand this point. Less sophisticated people in this country don't. And that's the real issue. The U.S. is a very exciting, dynamic, amazing place. And the emerging markets look to the U.S., frankly, for leadership. And it's not about ideologue, it's about pragmatism.
We're coming to almost an end. I want to turn the mic to Scott to make a last comment and then Nina to close it. All right? Scott.
I didn't know we were doing last comments, but
you could pass it.
No, I would just say that one of the things I'm excited about, and I do think the U.S. over time will get this right and be a winner, continue to be a winner in a global competition. But as Nina had said, there's going to be a lot of winners, and as a portfolio strategist, I want to be part of all of those places that are winning, whether it's in the U.S. and the emerging markets or in Western Europe. And I think it's a very exciting time. Change in many ways can be very good for investing. And so when there's a lot of change, a lot of interesting things going on around the world, that's very exciting for me as an investor.
Nope, you're fine. So I want to thank our sponsors. But before then, I just want to give notice to our sponsors and the Notre Dame people, and that is we need to have an explicit, systematic conversation about the education we need to provide for our students on emerging markets, and the type of experiences. I'm just serving notice to my friends. But at this point, then, I just really want to thank, first of all, our speaker, Ninad, our panelists, Shep, Gary and Scott, but the people who made this possible financially, as we have Roxanne Martino and Gary Garabin. So let's give everybody a big hand. Oh.